Good morning. It's great to be back with you today. Happy 2025. Wishing you all the best for this year. And we've really started the year with maximum volatility. Trump dominates today's slides. In fact, I've got Trump on 4 of the divider slides, which is certainly a record. But there's lots of things happening around US policy and around Trump. So we'll focus on that today. I will also give you an update on DeepSeek and the impact that is going to have on the US technology sector and future AI. So that's pretty exciting. And finally, at the end, we have Lex joining us. He's a quantitative analyst at Signia, and he's going to be highlighting the tax savings that are available before the February tax year end. Only a few more days left until our tax year ends, so stay posted for that and see exactly what you can put into your TFSA and your RA before the end of the year. But let's start with January market movements. Sure. Again, a lot happening in January. The standout performance was Euro Stoxx 50, up 7% in Rand terms. That was on the back of some fabulously strong luxury company earnings, which was very good. Good for Europe in general. Also good for our transnational fund, which you'll see on the next slide, which is the top performing SA equity fund for the month on the back of those strong luxury earnings. And that fund has 10% enrichment. Which was up nearly 30% in January. Then what else? Healthcare having a good rebound of its lows. Healthcare struggled in 2024, as you know, mostly because of high interest rates staying higher for longer, but also some disappointing data coming out of Eli Lilly and Novo. And we did have some positive news finally out of Novo in January, so that helped healthcare recover somewhat. Gold also looking good, up 6% in Rand terms, and that's on continual buying from emerging market central banks. Gold seems to be a one-way bet right now. If you think EM's central banks are going to continue to buy, well, it keeps going up. Even with all the volatility that happened during January, Bitcoin fell at one point. Ethereum, Ether was down 27% intraday. Gold barely blinked. So when it comes to those alternate assets, gold seems to be invulnerable right now. We still don't hold any in our portfolios, but if you are confident that central banks can continue to buy, then it's something to look at. Otherwise, everything looked pretty strong. Japan was down slightly, and dollar cash, global bonds down, but those on the back of a strong Rand of the month and higher interest rates. Okay, so what else can we say that feeds through into the returns? As I said before, Europe doing very nicely, up 6% in terms of the fund returns. Transnational up at second place, 6.1% for the month. Healthcare up in third and fourth place, and then SA equities in fifth place. What's important is there are no FANG stocks in the top 5, which does make a change. FANG stocks still looking well in the 12 months with a decent return of 41.8%, first and second place. And then EMs in the third place, fourth Industrial Revolution, which is pretty much also US tech. It's NASDAQ 27% ahead of S&P 500 or MSCI US, pretty much the same thing in fifth place. But no FANG stocks during the month because certainly US tech stocks had a tough month in January, and that's pulled the US down relative to Europe and other developed markets. So it was all about DeepSeek. I'm sure you've all heard about DeepSeek. It was major market moving news. It was the #1 app on the US App Store the weekend after it opened, and it had everyone concerned about the impacts that it would have on the US tech sector. Nvidia fell 17% on the news on the Monday, the largest single stock collapse from a market capitalization perspective ever, wiped out more than $500 million, and had big concerns that the AI race was over with this massive disruption that was coming in from China. So if we look at the DeepSeek R1 model, it certainly is innovative. It has 2 clear innovations that allow for cheaper runtime and cheaper training costs. The first is caching of intermediate thought processes, and the second is reinforcement learning. Both very clever ideas, and allow for basically cheaper AI models. In fact, the tokens, when the app came out, were 97% cheaper than the comparative open AI tokens. So at 3 cents on the dollar, it seemed like a bit of no-brainer. Now, it's not perfect. It had some clear innovations on one side, but it did have shortcomings. Firstly, it's only in English and Chinese compared to multiple languages on your other models. It's not multimodal, which means it doesn't do voice and video. It doesn't support corporate integration, which is a big one. So if you do want to set up a chatbot for your company, you're going to struggle to use DeepSeek for that. So what does that bring us to? Well, it means that we are moving faster in terms of that innovation in the AI space, which is great. Certainly, it's open source, so US technology companies will be desperately trying to catch up. At the same time, Chinese tech companies will be trying to catch up where they are behind on the AI side. So I do think that the arms race is going to continue. That the 600 odd billion in capex over the next 3 years is most likely not at risk. But the problem is, we sold out of our FANG stocks and we sold out of our fourth industrial revolution stocks to go underweight tech at the end of last year on the concerns of how these AI companies would monetize AI. And DeepSeek certainly doesn't help that. In fact, it makes it more difficult. So while we think that the capex is going to continue and probably will benefit companies like NVIDIA, and while we do think that corporates are going to continue to use AI models for their chatbots, whatever, which will benefit the integrated companies like Microsoft. For the rest, it becomes much more difficult to monetize their search engines and their chats. So we remain underweight US tech. We do have exposure to US through consumer staples and through mid caps, and we keep that exposure for now. As this just means that it's going to be more likely more expensive to keep up. So more money is going to be thrown at it, but even more difficult to monetize as there's a lot more competition. So we keep that view unchanged, underweight US tech, but we're not too concerned about our favorites, which are NVIDIA and Microsoft, given they do have large moats. But the bottom line is that whereas tech used to be seen as the safe haven, the mystique around it has been popped by what's happened from China. So all of a sudden, people are no longer thinking that it's a one-way bet. And that certainly means that the premium that was being priced into these models is going to unwind. We were quite concerned about that premium at the end of last year, but we think that there could be further headwinds to that over the next 6 months, that people properly digest exactly what's happening and what the impact is to their models, and how that all impacts on the price. So some volatility ahead for the US technology sector. Okay, so let's start off with the chart of the month. And I think this is a fascinating chart, and I think it defines the last 15 years since the great financial crisis, the slow growth we've seen since 2008. We've seen Grexit, we've seen Brexit, we've seen so much unhappiness, misery on the consumer side, and it's finally reflecting in terms of underlying voting results. So the chart on the right is from Financial Times, and it shows that for the first time, as far back as this goes, but it's over a century, for the first time in over 100 years, every developed country governing party facing election last year lost vote share for the first time ever. So if you go to the very right-hand side, you can see that the dots, which is the average of all elections in the year, and then the lighter one is individual elections. But you can see that every dot is below zero. And so for the first time, every governing party facing election lost vote share. And it just means that there's widespread dissatisfaction with the status quo. Now, why? Or we could have a bottle of wine and a big philosophy debate about that. But slow growth has to be a big one. Increased inequality is certainly a big one. Or QE, resulted in a massive inequality. To some extent, social media and the way that fake news is being spread through social media must also impact it. I believe that it's also a reflection of overpopulation. There's just fewer resources on this planet, and there are a lot more people. So even though the number of people who've got minimum standards has vastly improved over the last 20 years, because there are more people, there are also a lot of people who don't have, or are having to give up things, and the average standards is dropping to some extent. So lots of reasons for unhappiness, and when there is unhappiness, when that pie is shrinking, people start to fight over it, and that's what we saw last year. So looking at some examples, so in the UK, the Labour Party ended 14 years of Conservative Party governance. We all know Republicans threw out Biden and took the White House. ANC lost its majority back home. Democratic Party in South Korea gained a majority. Meanwhile, in India, Minister Modi's party lost their majority. Germany is facing early elections in February after the collapse of their governing coalition. It's chaos in France, and Canadian Prime Minister Justin Trudeau renounced his resignation in January. So a lot of uncertainty and a lot of change. So what's happening is we're seeing political leaders being forced to become far more populist to gain power or to retain power. And as governments increase their involvement in the underlying economies, so that political volatility is feeding through to economic volatility. And that's certainly what we saw in January. Trump is a perfect example of this. Trump is a perfect example of nationalism causing volatility, of politics causing economic and market volatility through his tariffs. And here he says, instead of taxing our citizens to enrich other countries, we will tariff and tax foreign countries to enrich our citizens. Now, honestly, that is a fantastic concept, and if you can do it, why not? Make everyone else pay, and you just sit back and earn your dividends. But it's not as simple as that, it's the volatility that we've seen in January is a result. So, looking at what happened in January around Trump's tariffs. So, as we all know, after he won the election, the proposals were 10 to 20% broad tariffs across the world, 60% tariffs on China, 20% tariffs on Canada and Mexico. Now, the market sold off towards the end of December and early January because people were worried that this would cause inflation and the Fed would have to hike rates. Then there was relief. Markets rallied because Trump came out and said, don't worry, everybody, I'm going to do a targeted approach. That was at his inauguration, targeted approach, and he appointed a number of federal investigators to understand exactly which countries weren't playing fair, and he would only tariff those countries. He did at the same time say he might put some tariffs in on the 1st of February, and then on the 1st of February, he did. And markets collapsed. The dollar rose, the bond yields rose, and there was widespread panic yesterday because he imposed 25% levies on Canadian and Mexican imports, which was supposed to start today. But last night, he delayed those both by 30 days, and the markets have recovered somewhat. He did impose 10% import duties on Chinese imports. That starts today still, and China has responded with very targeted tariffs. He also said that the EU must quickly buy more US oil, otherwise they will face these tariffs. Now, this all talks to increased uncertainty. And there's one thing that markets don't like, and there's one thing that businesses don't like, is uncertainty. You can certainly believe that at Signia, our investment committee has been working flat out to try and understand what this means for our portfolios, what to do. And I'm sure CEOs around the globe are wasting precious productive time sitting together, trying to understand what Trump is going to do and how they can best resolve that. So uncertainty is not good for anybody. And this was reinforced by the January 2025 IMF World Economic Outlook. And their January report was titled "Growth on Divergent Paths Amid Elevated Policy Uncertainty." Basically, when you don't know what your political or economic policies are going to be, it's very difficult to invest accordingly. They do say that this is not going to cause a recession. So global growth is projected at 3.3% in 2025 and 2026, below the 3.7% 20-year average. So we do expect that low growth. That's what we've had since the great financial crisis, but not recessionary. And they did upgrade. If you look at the chart on the right there, you can see that the second to right data point was their estimates for 2025 growth in October. And now in January, they've upgraded Chinese growth, they've updated US growth, but they've downgraded European growth, the rest of the developed markets and the rest of emerging markets. And things are looking quite poor around the rest of the world. Really, the only good news coming out of in terms of growth perspective is the US, and China still struggling, but struggling less than it was. So some positive upgrades both in the US and China. Now, it's all about Trump, and he didn't let us down. And at Davos, before he announced all these tariffs, he said, I'll demand that interest rates drop immediately, because Trump knows that inflation is what caused the Democrats to lose the election last year. He won because of cumulative inflation over, and mostly it was due to COVID, to be fair, but cumulative inflation over Biden's reign, and that is what he needs to avoid. So he said, I'll demand that interest rates drop immediately. Now that causes inflation, but at the same time, it does reduce the misery index in the US, so you can kind of understand it. But he's trying to influence policy. The Fed rightly kept rates flat at the FOMC meeting in January, in line with market expectations. There was no surprise. Trump immediately lashed out, and he said, if the Fed had spent less time on DEI, which is diversity, equality, and inclusivity, less time on gender ideology, less time on green energy and fake climate change, inflation would never have been a problem. So there's a lot to digest in there, but anyway, he is trying to push the inflation focus onto the Fed. And as I said, inflation is the key focus. He knows he needs to make sure inflation falls. Otherwise, he's not going to be popular for very long. Now, he does have a clever plan around getting inflation to fall, or at least headline inflation or core, around oil. And I'll talk more about his oil plans later. But the important thing is that the markets last year were worried about a US recession. We weren't. We were over at the US and over at equities, and it worked well for our portfolios. But the major concern was, or the major risk was, a US recession. The markets are now focusing away from that. And the major concern this year is not a US recession, but it's accelerating inflation in the US, which causes the Fed to hike. And that then causes a recession later on, maybe in 2026. So the biggest risk now to growth in 2025 is reaccelerating inflation due to Trump's tariffs. So we have to understand exactly what's going on from a tariff perspective. Now, so the US is doing very well. In fact, the US is booming, and it's part of the reason that interest rates are high and the dollar is strong. It's not just the tariff story, but it is very strong US growth. Consumer spending in the fourth quarter of 2024 advanced at 4.2%, which is its fastest pace since 2021, 4-year high on consumer spending. So the US is pumping. And that is why people aren't too worried about a recession. They're just worried that the strong growth and tariffs will lead to reaccelerating inflation. Now, we don't think that is a big concern. We're keeping our base case, which is that inflation will continue to fall slowly. Why? One of the things that was a concern was that the Michigan 5 to 10-year inflation expectations rose to their highest level since 1996. But part of that increase was due to the oil prices, which rose in early January and December, and I'll talk about oil later, but we don't think oil is a big risk for this year. We also think there will be a growth slowdown in the US, not recessionary, but there is going to be a slowdown because mortgage applications have fallen to a 10-year low, which means the whole housing market slows down, and US bankruptcies are at a 14-year high, which again means that investment is going to slow down. So those are important data points to understand why the US is not going to continue accelerating. Then just looking at inflation, super core services inflation rose just 0.2%, making its lowest increase since July. So that's great. And then one of the things that is keeping core inflation slightly above where we want it to be is shelter. So if you look at the chart on the right, or the top chart on the right, you can see that core PCE, the cyclical part, is well below 2%. But the other parts, acyclical core and shelter, are keeping that up. But if you look at real-time rent prices, those have fallen to just 1%. And so we do think that that will keep core inflation falling nicely, despite what is happening. Then the other thing which is very important is the strong dollar. The strong dollar reduces import inflation, and a weak China deflation. It means that Chinese import product prices continue to fall, and that does help US inflation fall. And then finally, it was just fascinating to watch what was happening in markets in January. Every time Trump threatened inflation, broad inflation, or tariffs every time Trump threatened tariffs, which would lead to inflation across any country, the dollar strengthened. And as he reduced those threats, the dollar weakened. So the dollar is working as this perfect market correcting mechanism where as he puts on the tariff, so the dollar strengthens, which basically reduces or unwinds that tariff, and so there's no import inflation, and that country, whichever country it is, can carry on exporting at the same levels. So the market is working against Trump, and he needs to realize that's one of the reasons why his policies aren't working, is that the market continues to work against him to unwind those policies. Okay, moving on to China. So at Davos, Trump and Xi Jinping got together, and Trump said, "It is my expectation that we will solve many problems together, and starting immediately." We discussed balancing trade, fentanyl, TikTok, and many other subjects. So China and America are actually playing quite well together. Trump initially promised 60% tariffs, so 10% is pretty much not nearly as bad as it could have been. And there is some negotiations ongoing around TikTok. And Trump's response to DeepSeek was actually quite interesting. He, instead of attacking China, he attacked American companies, saying America needs to continue to innovate, and America is falling behind on innovation. So, to some extent, Trump is acting less of like a populist and more like a plutocrat, which has its own challenges, but it is good for markets. But for now, things are looking relatively benign for China. And growth within China is looking quite good. China achieved its 5% growth target in 2024, despite a lot of people thinking it wouldn't. And the data at the end of the year also looked robust. Robust retail sales, industrial profits. And after 3 years of decline, Chinese home sales have finally turned positive in 2024. And that's a big change. Chinese property market has been a huge drag on growth for the last 3 years. It's not going to drive growth, but at least it's going to stop dragging down growth. A zero is better than a negative number. Not only that, but we are starting to see some of the impacts from Beijing's massive counter-cyclical measures. So let's look at that. I mean, these are not, maybe not bazooka impacts, but they're really, really serious. So the Politburo, led by Xi Jinping, implemented a moderately loose monetary policy, which may sound boring and pointless, but the last time China had a moderately loose monetary policy was during the Great Financial Crisis. I mean, that was a serious recession, nearly a depression. So that's how serious China is taking this. Not only that, but on a fiscal side, China has set a growth target of 5%, which they have done for a while, but they plan to raise the budget deficit to 4% of GDP. That's the official one. The unofficial is close to 8%. But the 4% is the highest level since 1994. So there's some serious focus on fixing the economy in China. Now, a lot of people said, well, China can't do that. They don't have the ammunition. They've got too much debt. Wrong. Look at the chart on the right. It is fascinating. The top panel shows the gross government debt for various countries. On the very, very left-hand side is Japan, because we all know that Japan entered they're the poster child for Japanification, for aging populations, for slowing growth. which is what China is facing, and they started this 30 years ago. So they know how to respond. But they did respond by taking on huge amounts of debt, over 240% of GDP. Fast forward all the way to the right-hand side, and you've got there China, not the lowest gross debt, slightly higher than South Korea and Mexico, but pretty low compared to developed markets. But what is more important and what is fascinating is that China has assets. All governments have assets, but generally, if you look at debt or assets minus debt, so you get your net financial worth, China is the only major country in the world that has a positive net financial worth, which certainly means they do have the ability to keep growth going by just spending, building roads, railways, more ghost cities, whatever it is. They can create jobs and do what Japan has done over the last 30 years. Now, something else is quite interesting. DeepSeek, the R1 model, could be a game changer for Chinese companies because it's the first major AI model to announce support for Huawei's chips, offering an alternative to NVIDIA's GPU-centric ecosystem. Now, because of all the bans that China is facing from chip exports from the US, this certainly helps them from a domestic perspective, allows them to keep up with the AI arms race using domestic chips. So we'll be watching that quite closely. But unfortunately, because despite all these positive things I've mentioned, the overwhelming concern is certainly still the threat of tariffs, what Trump could do, even though he may not do, and that's keeping confidence in check for the short term. That, and we're also going through the Chinese Lunar New Year, and it's only really in March that we start to see some clear data come out of China and some big economic updates or policy changes. So, we are remaining underweight China and emerging markets with a bit of a wait and see approach to see if things change there. Okay, I promised more on Trump. Here you've got Trump shouting, "Drill, baby, drill." And that is one of Trump's key policies to reduce inflation. And certainly it is a clever idea. So we did have some concerns. I mentioned that the Michigan inflation expectation survey rose to a 2-decade high. And that was on the back of Biden's Russian sanctions. Now, those are pretty comprehensive sanctions. In fact, that they're one of the largest measures taken against Russia's energy sector since the war started. And it targeted not just the energy sector, but everything around that, including major oil producers, vessels that transport oil, and entities involved in Russian oil trades. So that's the concerns that it would reduce Russian oil output, led to prices rising. But then we had Trump come out, and the oil price fell on Trump's declaration of a US energy emergency. Trump said, "We sit on the most oil and natural gas of any nation on earth, and we're going to use it." So not only did he remove the US from the Paris Climate Accords, climate change be damned, we're going to drill, baby, drill. But he unleashed, he had his executive order which unleashed American energy, and that restarted licensing for LNG terminals and revoked measures that effectively block drilling in most US coastal waters. So we are going to see an increase in US oil production. It'll take time. Trump plans to increase US oil production by 3 million barrels a day. Just to put that in perspective, Iran's total oil production is $1 million. 1 million barrels a day. So that's 3 times Iran's production. So that would have a big impact. Don't know if he'll get there and how long it'll take, but he certainly wants to keep the oil price in check to keep inflation at bay. And to some extent, that may offset some of the tariff concerns, but not completely. Now, longer term, we agree that oil is not going to be a big driver of inflation. If you look at the chart to the right there, you can see that US crude oil production is at its peak, and that's before Trump even starts with his deregulation of the oil sector. But equally important is China, which has gone past its peak demand. And part of the reason for that is that China's EV adoption is 5 years ahead of its planned target. So China seeing lower demand for oil, America higher supply, and that's keeping a surplus. And that is then reflected in the bottom chart, which shows OPEC's oil spare capacity, and that's sitting at 5 billion barrels a day, and that as well will keep oil at bay, even if there are some disruptions of oil supply. Okay. Moving on to South Africa. Here we've got our Minister of Finance who attended Davos. He said South Africa's focus is on reforms, not on credit ratings. And that is correct. We do need to, South Africa needs to focus on reforms to get growth back on track. Now, there was some volatility in January because there were concerns that the GNU was falling apart after the land expropriation bill was signed without the consent of the GNU. The DA declared a formal dispute and asked for a reset around that and around NHI. And certainly there was a lot of volatility, but it looks like the GNU is here to stay, at least for 2025. So that does give some comfort. Unfortunately, we're now in Trump's spotlight, which is not good. You know, one of the things that South Africa had going for it is that we're a small open economy at the bottom end of Africa that no one cares about or even knows about in America. And so that was a plus. But most likely due to Musk, South Africa is fully in Trump's crosshairs, and that is not a good thing. So that's something to worry about. Now, the other thing that was good or tailwind for South Africa was load shedding. But as you all are very well aware, load shedding is back. I did find it suspicious that the day after NERSA announced that Eskom would only get a 12.7% price increase when they wanted 36%, that the lights went out. It was almost, I mean, I'm sure it wasn't Eskom throwing a tantrum and trying to show how important they are, but some people might perceive it like that. Anyway, so we now have to worry about load shedding and whether load shedding is going to be back or not. We have to worry about what Trump's going to do. There are a lot more risks to emerging markets in general because of the strong dollar. One of the good things is that inflation remains low. That's unfortunately because growth is so low, but at least we get the silver lining of low growth, which is low inflation, and that allowed the SARB to cut rates by 25 basis points in January, so that does help. Looking at growth forecast for 2025, it's up from 2024, but still a pitiful 1.6%. And we had the IMF report come out a few days ago, and they're very concerned that we're not going to see debt consolidation, that growth is not going to be strong enough to drive employment, and it's not going to be strong enough to pay down debt, and that we're stuck in this high debt cost downward spiral. And it's not a great report from the IMF, but probably pretty realistic. Now, things have improved, and they are improving due to reforms. The GNU has definitely led to more private sector involvement, even though it's called something else. And we've seen that on the electricity side through the Renewable Energy Independent Power Producer Procurement Program. Our governments do love their nice long titles. And Transnet has also increased private sector operations in its terminals and maritime infrastructure. Not in Cape Town, unfortunately, but we have seen it in the rest of the country. So hopefully that does get to Cape Town eventually. The bottom line is that business confidence has improved. We are back to the second highest level in 7 years, which is great. Still not a great level, but it's great to see an improvement. Unfortunately, consumer confidence is lagging and still very low due to low employment, due to job losses and elevated levels of household debt. Now, I've mentioned a lot of risks as well. Being back in Trump's crosshairs, strong dollar, which is bad for all emerging markets, load shedding. But the big risk for 2025 is certainly water. And city of Joburg, 45% of water revenue has not been collected, which is not sustainable. And given the significant underinvestment in water, the lack of technical expertise, non-collection of water bills, and endemic corruption, water is probably going to be the new energy in 2025. That, and I saw an article on Johannesburg bridges, which is just terrifying. So infrastructure literally falling apart. And that's quite worrying. We also have the budget coming up, and most likely it's going to surprise to the downside with less consolidation of debt than we want, due to probably higher expenditure on the public sector wage bill. So that's another concern. So we remain underweight South African bonds because of all these risks, neutral South African equities, because we do think things are improving, but there's also been a decent recovery from SA Inc. A lot of that improvement is being priced in. So that brings us to the overall positioning before I hand over to Lex. Okay, so how's our outlook looking? Well, we have been overweight equities for a long time now, for over 2 years, and it's worked very well for our portfolios. And markets have risen very nicely. We are turning more cautious. It's because it's becoming more difficult to understand exactly the impact on growth that Trump's volatility is going to cause. Now, the transmission mechanism is business confidence. As I said before, we've got CEOs around the world trying to work out, what does this mean? Do we cancel this new factory? Do we relocate this new factory? Do we stop hiring people? Do we fire people? That uncertainty leads to lower investment, and lower investment leads to lower growth in jobs and the overall economy. So what's happening right now is not good. We don't know the full impact, but we are turning more cautious, despite the fact that we are still seeing strong US earnings coming through. So it's a lagged effect, but we are seeing strong US earnings, and we do think that inflation is going to continue to decline moderately over this year. And the US does have easing regulations. We've seen that clearly in the oil market, and tax, which will at least stay at the lowest level in the world at 15%, and that all helps business confidence in the US. The biggest risk, as I've said before, moves away from a US recession towards re-accelerating inflation in the US because of tariffs, so we're going to watch that. Volatility is going to stay high until we have certainty about Trump's policies, and we're unlikely to see certainty. That's the problem, is that Trump's negotiating style relies on uncertainty. So you're going to have threats, which most likely are pulled back. But while there's this toing and froing and potential retaliation, well, it's going to lead to heightened volatility, and it could last for 4 years. And that's not a good thing. And it definitely has a more negative impact across the rest of the world, emerging markets in particular, but also Europe and Japan, as tariffs are going to be around the world from the US. And the rest of the world, besides China, has less of an ability to respond, particularly Europe. Europe's in a particularly bad spot because most of Europe, particularly Germany and France, they run on coalition governments, and coalition governments, as we know, the GNU, very difficult to get anything done. So it's much harder for Germany and France to balance those tariffs with huge amounts of fiscal stimulus, which we're already seeing happen in the US. Other risks include the rapidly innovating AI space. We have to worry there about creative destruction, and we could see some huge write-offs of CapEx and developmental spend that's happened if there's no longer monetization on certain developments that have happened. We have seen a truce in the Middle East, which is fantastic news, very, very, very welcome, but geopolitical risks remain always, so we're watching that space. And on that note, one of the things that Trump promised on his first day was an end to the Russia-Ukraine war, and we haven't quite seen that yet. So we may see some volatility pop up there when that happens. Now, there's always upside risk as well. China could unleash more policy support, which actually drives consumer confidence in China and domestic consumption. That'd be great. European fiscal stimulus, less likely, as I said, because of the coalitions, but not impossible. And then the chart on the right is I think, fundamental to everything. When you take all the volatility aside, markets tend to climb a wall of worry. And despite all that's going on, if Trump doesn't put in any of these massive tariffs, and it's all just threats that are then unwound, and as a result, there's no downgrade, or only a small downgrade to growth, and there's no recession, well then, the chart on the right is very important. So the chart on the right takes the last 7 economic cycles in the US, and the vertical dotted line is the time point of the first rate cut. And the red line shows the market after that rate cut when there's a recession in the next 12 months, the following 12 months. You can see there that the markets fall about 10% in that case. The green line shows what happens if there's no recession. The market's up about 20% in that case. The average of all of them is a flat market. And you can see the orange line is where we are, which is slightly up, in fact, pretty much in line. But we could, from this point, if there's renewed confidence that growth is going to remain, markets could rally another 15%. But if there are concerns that Trump's going to push the world into recession, well, then the markets could fall 10. So there's some big swings depending on exactly what Trump does to growth. It's very, very difficult to forecast. And that's why we are turning more cautious in our outlook. Our base case is still that we see equities outperforming bonds outperforming cash, but that spread is narrowing to the point where you're getting maybe 1 or 2% from equities above cash, in which case, unless you're a very long-term investor, you start to wonder if it's worth the volatility. If you're a short-term investor, well, you might say, well, why do I want cash plus 2 with 20% volatility if I can get cash with no volatility? So that then starts to see people selling equities and rotating into cash, and that then further pushes markets down. But if you are a long-term investor, well, you don't want to lose out on that extra 2%. So that's currently where we are. Okay, so that is it from the macro outlook. Things are looking tricky. We've got DeepSeek, we've got Trump, a lot of volatility in January, and certainly a much more tricky 2025 than we had in 2024. But I'm going to hand over to Lex now, who will take us through the tax season update. Thanks, Lex.
Thank you very much, Carl. That's fascinating as always. Just 1 second, let me get my screen up here. I think we are ready to... 1 second, this is blocking what I'm saying. Here we go. Sorry, welcome everybody. Today we're exploring a topic for building a strong financial future, and something I've always battled with: patience. Specifically, I want to show you the importance of staying in the game and resisting the temptation to withdraw from your tax-free savings accounts and your retirement annuities, particularly with the new two-part system in place that we have now. So to start off with, I think let's go through what TFSA and RA are. All right, so here we go. So TFSA, introduced in 2015, the tax-free savings account is designed to encourage South Africans to save by offering tax incentives. You can contribute up to 36,000 Rand per tax year with a lifetime limit of 500,000 Rand. The best part, the returns on these investments, whether through interest, dividends, or capital gains, are completely tax-free. This allows you to your investment to grow without any tax implications, making the most of compound interest. Unlike retirement annuities, tax-free savings accounts offer more flexibility. You can withdraw funds at any time without penalties. However, keep in mind that withdrawals do not reset your contribution limits. If you withdraw 10,000 Rand, for example, you can't replace it. Your contribution room is permanently reduced. We'll revisit this later in the presentation and explore the consequences of withdrawing money, both in terms of a loss of capital gains and the permanent reduction in your contribution room. Now onto retirement annuities. This is a personal retirement savings plan designed to help individuals accumulate funds for their retirement years. It's especially beneficial for those who are self-employed or whose employers don't offer a pension or provident fund. One of the key benefits of an RA is that contributions are tax deductible. You can contribute up to 27.5% of your taxable income or gross remuneration, capped at 350,000 Rand a year. This means that you can reduce your taxable income while saving for retirement. The growth of your investment within the RA is also tax-free, which allows you to set your savings to compound over time without the drag of taxes. And unlike some other retirement vehicles, an RA offers ownership and portability. You don't have to exit the investment if you change employers. Plus, you have control over the strategy, meaning you get to decide how your funds are managed, not your employer. Another advantage is flexibility in contributions. You control how much you contribute without relying on your employer's contributions. When you reach retirement age and you want to access your funds, the first 500,000 of any lump sum withdrawal is tax-free, which is a big benefit, obviously. The remaining 2/3 of your accumulated funds must be used to purchase an annuity. An RA also offers creditor protection, which means the savings are safe and cannot be claimed by creditors, providing extra security for your financial future. Until recently, access to the fund was restricted until the age of 55, which ensured that your savings were preserved for retirement. But we'll cover the recent changes shortly, which have been made, and some of the rules around accessing your funds. And now we come on to the two-part system. As mentioned, until recently, withdrawals from your retirement annuities were restricted until the age of 55. However, with the introduction of the two-part system on the 1st of September 2024, South Africa's retirement landscape has undergone a significant transformation. Let's break down what this new system means for you. Under the new system, retirement contributions are allocated into two distinct components. 1/3 of your contributions are allocated to the savings pot. This pot is designed to provide accessible funds for unforeseen financial needs. You can make one withdrawal per tax year with a minimum withdrawal of an amount of 2,000 Rand. However, keep in mind, these withdrawals are subject to taxation at your marginal tax rate. So it's important to factor that into your decision-making process. The remaining 2/3 of your contribution are allocated to the retirement pot. These funds are exclusively reserved for your retirement and cannot be accessed until you reach the official retirement age. This ensures that a significant portion of your savings is preserved for its intended purpose to support you in retirement. In addition to these two pots, there's also the vested component, which consists of all retirement savings accumulated before the introduction of the two-pot system. These funds will continue to be governed by the rules that were in place before the reform, meaning they generally cannot be accessed until retirement unless specific conditions are met. So now you might be thinking, okay, if I really need some money for something I really want, like a new wardrobe or an upgraded flight, and it's going to do well in the future, I mean, why not just dip into my tax-free savings account or RA? How bad can it be? Bad. But you don't have to take my word for it. In the next few slides, I'm going to show you why. Simply put, your money has a potential to grow over time through the power of compound interest. The longer you leave your money invested, the more it can grow. Seems simple, right? Let me give you an example that I think will blow your mind. $141.7 billion of Warren Buffett's $146.7 billion fortune came after his 65th birthday. That's 96.7% of his total wealth. And while it might be tempting to say that maybe he's just gotten better at investing over time, or that the economy has simply gotten stronger, let's take a look at these two figures. One of these rates of return got him from $10,000 to $5 billion, and the other from $5 billion to $146.7 billion. Which one do you think got him that extra 141 billion? Yep, his fortune has grown by 12.1% annually over the last 30 years. It hardly seems possible that $141.7 billion can come from just 12.1% growth, but that's the power of staying in the market. On average, from a young boy doing his paper route in 1940 to today, he's grown his wealth at an astonishing 22% annually. Now imagine this. If he had only started investing at 30 with $25,000, and then decided to retire at 60 to go and play golf, his net worth today would be only, and I say only in a very, very relative sense, around $10 million. Armed with that knowledge, let's consider the impact of withdrawing from your RA or your TFSA. While it might seem like an easy solution to immediate financial needs, this decision can have some serious long-term consequences. Let's just imagine Larry. He's overspent his December budget, but his friends are now trying to convince him to go on holiday. All he needs is 50,000 Rand. Normally a responsible investor, Larry thinks, I've already been reckless. What difference would another 50,000 make? I can always make it back. Well, Larry's in for a big shock. Let's do a simple test here just to see how wrong he is. Larry wants to withdraw 50,000. He's got 20 years to retirement and currently earns 450,000 Rand, very diligently putting 8% of that into an RA and the same into his TFSA. Larry knows that if he withdraws from his RA, he'll have to pay tax at his marginal tax rate. And he's right. On a 50,000 withdrawal, he'll end up paying 22,463 Rand to the taxman. So thinking he can avoid that, Larry figures, why not just take the money out of my TFSA instead? After all, withdrawals from TFSAs aren't taxed, right? But is it really that simple? Let's dive into the numbers and compare what happens if Larry decides to dip into his RA and then his TFSA. That 50,000 in Larry's RA, using the Alexander Forbes Global Large Manager Watch median returns, would have turned into nearly 670,000 Rand in 20 years. For what it's worth, had it been in the signature 70 range, it would have been way more than that. Now, let's see what would have happened with his TFSA. If he were to take money out of his TFSA, he may not pay tax, but his lifetime contribution cap would be permanently lowered. Using the last 20 years of the MSCI All Country World Index return, here's what we see. The loss starts lower since you don't have the tax impact. If the loss returns were the only losses, it would be represented by the dotted blue line. But the green line shows the effect of the contribution ceiling kicking in. In Larry's case, his cap is permanently reduced to 450,000 Rand, which means in year 6, his contribution limit is reached, and from there, the loss accelerates even faster, ultimately reaching a whopping 776,000 Rand. In short, withdrawing from either a TFSA or RA is a terrible idea and should only be considered in the most dire of situations. As the end of the tax year approaches, make sure you are ready and prepared. At Signia, we offer a range of products designed to help you maximize your tax-free growth potential. Our low fee structures and diverse investment options make it easier for you to stay the course and achieve your financial goals. After all we've spoken about, it should be clear that time is your most powerful ally. The Stargazer TFSA, which you can open on behalf of your children, transforms what might seem like modest contributions into a substantial fund that can help secure your child's financial future. In the world of investing, patience and perseverance often prove more valuable than quick short-term gains. By staying the course with your TFSA and RA, you're giving your money the time it needs to grow and benefit from the power of compounding returns. Although it might be tempting to access your funds prematurely, especially now with the added flexibility of the two-pot system, consider the long-term costs. Every withdrawal chips away at the power of compound growth and can impact your financial security down the line. Remember, your TFSA and RA are not just savings accounts. They're strategic tools that rely on time to deliver their full value. By committing to these investments, letting them grow undisturbed and making informed choices, you position yourself to enjoy a stable, comfortable retirement. Patience, as they say, truly pays off. Thank you very much. And I think now we'll pass it back to Kyle for some questions and answers.
Thanks, Lex. That's brilliant. Okay, Let's look at some Q&A. Chris asks, do we use derivatives? We definitely do, Chris. Derivatives are a very important tool, a very low-cost tool, so that we can reduce risk where we need to. It gives us an opportunity to in many cases, hedge the currency. If we think we want to be, often when markets fall, the rand weakens, and becomes a good entry point for global equities, but you don't want to take on the weak currency, so we can separate that decision using derivatives, which is very good. Obviously, it has to be done in a very careful manner, and it's well monitored, but we do use derivatives in our portfolios. George says, how has SA Property done? George, SA Property's been a fantastic performer. It did very well in the first half of last year, but gave up some of those gains towards the end of the year. There are still structural headwinds for property in South Africa. Hopefully load shedding is behind us, but definitely work from home is still an issue. There was an oversupply of retail and office property. Immigration in various different directions hasn't helped. And infrastructure also is a problem where a number of landlords have had to either provide their own water or electricity, all hurts SA Property. But certainly looking more attractive now than it has been in the past. And we do have some SA Property in our portfolios now. Not a large amount, but we do have direct SA Property exposure, which means basically we're overweight relative to our strategic benchmark, which doesn't have any. So we've got a little bit of that. It's a question on EM, central banks buying gold, and they point out that the Bank of England has also been buying a lot of gold. Certainly that is the case. I think everyone's feeling a little bit left behind when it comes to this gold rush, and so there's some panic buying. I can't forecast the gold moves very well. I can tell you that it's more than double the cost of getting out the ground, which has to be important at some point. But while there's strong demand, the price moves up, a bit like Bitcoin. Then also a question asking me to compare the Signia iTrix S&P Global 1200 ESG with the Signia MSCI World Index. So those are two broad passive indices and funds that track global stocks around the world. MSCI World has about 1,400 stocks. S&P Global has about 1,200 stocks. They are quite similar. The ESG overlay does reduce the S&P fund to about 1,000 stocks, but with very, very low tracking error. I think the main difference to highlight is that the S&P versions, S&P Global has about 4% emerging markets, whereas MSCI World doesn't have any emerging markets. So depending on your view on emerging markets, you can switch between the two, but at 4%, it's a very marginal impact that impacts the performance of those two funds. Mr. Naka says, is it wise for those countries running trade surpluses to engage in a trade war with the consumer nation markets they need access to? Certainly that is the issue. The rest of the world would love to ignore the US and just start trading with each other. But Europe's got a massive trade surplus. China's got a massive trade surplus. The US has a big trade deficit. So the world relies on the US consumer, which is the consumer of last resort. So it's difficult to plan without knowing that US consumer is not there. That said, one of the reasons that US consumer is there is the US budget deficit is more than 6% of GDP. Whereas, as I said, China is moving its budget deficit from 3 to 4. Europe's around 3. So potentially the rest of the world can start driving domestic confidence and domestic consumers will start buying more and they can replace the US consumer, but that's a long-term strategy. That's definitely not going to happen overnight. And that's why people can't ignore the US, and that's why Trump does have so much power, because he is the custodian to the world's largest buyer, which is the US consumer. So it does make things difficult, but certainly longer term, these US policies have to force countries to create their own domestic demand and move away from the US, because no one can function with this volatility. So you're forced to find alternatives. But that's not an easy thing to do in the short term. Alberto says, would it be a good idea to add China exposure to a client's offshore portfolio? What is your expectation view on China in the next 2 to 5 years? That is a very, very tough question to answer. We do have China in our portfolios. We are underweight China, but we do have some. We did start to buy when China changed its view and started to be much more aggressive. As I said, there's some seriously strong support happening on the monetary policy side and on the fiscal side. That said, it's going to take a while for consumer confidence to change, particularly now with tariffs. So I don't think there's any rush to get into China. And China's still, it's a communist socialist country. They're not concerned about return on equity. They're concerned about looking after the people. So it is difficult for Chinese companies to show excessive profits. Which makes China a strategic, well, at least a strategic headwind for China in the long term. So that is something to worry about. But certainly, as I said, we do have some China, and the entry point, China is definitely looking cheap, and they may have the best ability to do policy which counteracts US tariffs. So it may be a good place to hide in the short term. We'll have to see exactly what happens around the tariffs. Alberto also says, what Signia funds invest in alternatives? So all our balance funds have exposure to alternative debt, to unlisted debt, but debt that is invested in infrastructure. So we do have some water infrastructure, we've got some energy infrastructure, we've got some telco infrastructure, and that is mostly government guaranteed, so giving a nice additional yield above your standard cash rate, while not taking on any additional credit risk. So some great individual debt positions there on the infrastructure side, classified as alternatives. And then we do have some exposure to OSE in the global equity side. That's in the unit trusts and on the life side. So that also gives us some exposure to mostly global healthcare innovative companies. So some great work being done on cancer research and other diseases. Calvin says, SA in Trump's crosshairs, not Trump directly, but via AfriForum. Certainly, Calvin, there are many reasons why SA is in Trump's crosshairs, whether it's Musk and Starlink or AfriForum. It's just something we don't want right now. We don't want South Africa to be excluded from any more trade agreements to reduce our competitiveness in any way. We're already so uncompetitive as it is. Any further headwinds is something that we want to avoid, regardless of the underlying debate, which is there. Shahid says the world is a mess. In the end, no one wins. While energy prices are a significant component of inflation, core inflation might not be as directly affected by changes in oil prices. Agree with you there. What impact will this have on wages and housing costs and overall inflation? So certainly, I agree with you that when it comes to inflation, oil is only impacts core inflation indirectly, but there is some pass-through, whereas the major impact when it comes to core PCE, the biggest exposure is shelter inflation. And in the US, we are seeing real-time rental prices coming down, so we do think inflation will follow suit in the US. But you're spot on about wages, particularly well, let's think about this. So how are tariffs going to work? So suddenly, Mexican avocados are 25% more expensive to the US consumer. Either the US outlets charge 25% more for their guacamole, and that is inflationary, or the company takes on that cost and they reduce their margin, and to ensure they don't go bankrupt, they have to fire people. So you either have a loss of employment or you have inflation, neither of which are good. And that is the issue with tariffs. Now, the good news is that Trump's advisors are smart and they know this. So we do expect tariffs not to be the only tool that Trump uses, and hopefully the smallest tool that Trump uses, because unless they are very specific and used in a particular way, they're going to do more harm than good to the US. And that's why you need to, and when China's retaliatory tariffs, I mean, the way they've done it is very clever and very specific and very targeted, that it doesn't impact Chinese companies, but hurts the US as much as it can. So, you know, there's so many unknowns when it comes to Trump's policies, but broad tariffs, blanket tariffs are not a good thing. Andrew points out that the 350,000 Rand RA contribution cap is not very big and has not increased in a long time. You're spot on. Effectively, inflation has eroded that cap massively. There's been a huge tax inflation creep in many sectors. I know at some point there was an ACISA working group that was lobbying for a raise in this cap, but given how little given the challenges to tax revenue in South Africa, I can't honestly see that ever moving up. It's at least a stealthy way of increasing tax revenue, as opposed to raising income tax levels, or raising VAT, or raising capital gains tax, or the new one, which is potentially taxing capital gains within unit trusts immediately. So, you know, no longer will you have a deferral of your CGT in a unit trust, so which is busy being debated. So there are lots of ways that taxes have been increased, which are not great. This is just one of them. Can't see it going away. Sean, this presentation will be on our YouTube website. If you want the TFSA slides, please email admin, and we will get the PDF to you. Hilgard asks obviously a very topical question, and I should have prepared better for this, but she says, why are Signia fees going up? That is unfortunate that our platform fees have gone up. We still are the cheapest platform in the industry, so we remain a low-cost provider. So that is, I think, key to remember. And we are looking to, I don't want to give away too much, but we are looking to introduce some family discounts. So keep an eye on that, which will reduce the impact of those fees. So I think that'll be quite exciting when it comes out. Claire says, please can you talk a little bit about Trump's tweet about withholding funding to South Africa because of the Expropriation Act? Should we be worried? Claire, as I've said, just being in Trump's, the fact that Trump can actually spell South Africa is not a good thing. The fact that we know where South Africa is not a good thing, because we don't want to lose any access to any trade deals that we have. I'm not sure exactly how this is going to play out and what the impact is going to be. It will be marginal, because we already have been excluded for a number of benefits. So I don't think there's the negative impact will be big, but it still will be another negative impact, and it's the last thing that we want. Marina says, please can you explain the benefits of excess contributions beyond the 27.5%? So Marina, the key here is that you get when it comes to RA contributions, they come out of your gross salary up to 350,000, the minimum of 350,000 Rand, or 27.5%. And after that, no longer it comes out of your net salary. So you're not getting that tax benefit. So it doesn't become as attractive from a tax perspective. Vickers says, some analysts think South Africa is an opportunity for external investments. Do you share the sentiment? Should one rather invest in South Africa? Vickers, as I've said, we've got a lot of benefits. South Africa is coming off a very low base, and it's not too difficult for things to get better. Growth is improving this year off a low base. Earnings will improve this year because of load shedding, coming off a low base, because of two pots, which pumped some cash into the economy, and because of some privatization, which will reduce supply side bottlenecks. There are a lot of reasons to be positive, but at the end of the day, we are a small open economy. And we are very dependent on global trade. We are very dependent on the dollar, and the strong dollar is a headwind to all emerging markets. So whereas I was quite bullish on South Africa towards the end of this year, I'm now much more concerned about emerging markets, including South Africa, because of the strong dollar, which just makes financing costs very difficult, very expensive, and it erodes profits. And again, it's all about investment. So if you're an emerging market and you get cheap funding, well, then you're going to set up a new supply chain and a new factory and try and find a new target market to sell your widget in. But when interest rates are high in the US, which they look like they are going to be for longer, and the dollar is strong, that funding becomes very expensive, and as a result, growth slows down in emerging markets, and that results in low employment, which means low consumption, and it has a whole knock-on effect. So Trump is trying to make America great again at the expense of the rest of the world. And the biggest impact it will have is on emerging markets, because we rely the most on global trade. Europe and Japan similarly follow suit, because they also rely on global trade, and they also are exporters, but they're less reliant than emerging markets. But the strong dollar is an issue. So we are concerned about that from South Africa's perspective. Chuck says, what is your outlook on the rand? I think that follows on from what I've been saying. I did think that the rand should be a lot stronger, probably mid-17s, but with the strong dollar and Trump's volatility and the knock-on impact that's going to have on global growth and global uncertainty, I think the rand will be stuck between 18 and 18 and a half. So I do think we're towards just the slightly upper end right now, where we are about 1870. I think that could come down a bit, but not much more. Fundamentally, the rand is cheap. We've got a strong trade surplus. We've got improving growth. A lot of reasons that the rand could strengthen, but unless we see some certainty from Trump, we're not going to get it. So another year of delayed party for emerging markets, another year of delayed growth. Emerging markets are high beta economies. They do really well when things are doing well, but since the great financial crisis, growth has been wobbly at best, and emerging markets reflect that the most. Abraham says, read an article this morning quoting a known guru. He said Bitcoin will be zero in the estimated 10 years. Reasons are the volatility and the inability to replace the current financial system. Thoughts? Well, that's certainly a bold call. We don't have any Bitcoin in the funds, even though we are trying to launch some products. We are working with the TFSA and the JSE so that those who want to invest can. We do want to launch an ETF in that space. I'm certainly one of the more pessimistic persons on Bitcoin. I don't own any. I've definitely have missed out, so maybe I'm a bit grumpy. But Abraham, you haven't shared the reasons why they would be zero. But I do think distributed ledger is a fantastic technology. There's no doubt about that, and I think it's going to be used in far more applications and companies going forward. And I think there's a lot to say for stablecoins, because that's got price stability and it's decentralized. Bitcoin itself is the starting point to get into any other cryptocurrency. So it has got this critical mass. If you want to buy some, I don't know, dog with hat, whatever it is, you need to buy Bitcoin first. So that alone will keep demand for Bitcoin high. That said, I did read a report in terms of about 6 months ago how to value Bitcoin. When it came to the actual cost of mining, it was around $15,000, so it's substantially lower. But then there were 3 other valuation methods which looked at a whole lot of things, including volatility, and they all had Bitcoin price ranging from $100,000 to $200,000. So it depends on your valuation technique. I can't see it going to zero, but I also struggle to understand why it's gone up so fast. I mean, the point of Bitcoin is that it has got limited supply. That I understand completely. There is a concern about debasement of fiat currencies. That is also something I fully understand. Countries around the world are printing money. They aren't backing that money with gold or anything, and that leads to inflation, and that leads to devaluation of the currency. That's why gold is going up. That's why Bitcoin is going up. That's why everything's going up. That's why you have billionaires buying Stegosaurus skeletons, because there's only one Stegosaurus skeleton of that type. And anything with limited supply will be a safe haven against debasement. The question is, if you've got a Van Gogh painting in your house, there is only one of those paintings. Limited supply to the point that it is only one, and it is a masterpiece. Has that gone up in value as much as Bitcoin has gone up? I don't think so. So it's that concern that I don't quite understand. Your gold has doubled, maybe your Van Gogh painting has doubled. So why has crypto gone up 20 times? I don't know. But yeah, it is a fascinating discussion. Ray says, can you recommend preferred gold miners to buy shares in? Well, wow. January was a phenomenal month for gold companies. I mean, most of South African gold shares up more than 30% in January. There's huge gearing in our gold companies on the back of a weaker rand and a strong gold price. And that feeds through into earnings. We've got the mining indaba this week in Cape Town. We have to see what happens there. But yeah, unfortunately, I don't have a view on any specific gold company, so I can't tell you which one to buy. It is a geared play on the gold price, and as I avoid the gold, I avoid gold companies. Another question from Ray says, is Signia view to avoid SA retail bonds at this point? What is recommended SA bonds? We are underweight SA bonds. Just because of the budget that's coming up, and because of the fact that we don't think South Africa is going to be able to get an upgrade to investment grade anytime soon, and because we don't think our debt to GDP is going to fall. I mean, it's gone from 25% to 75%. To get that back down with our low growth is very, very unlikely. So we are underweight SA bonds at this point. That said, if bond yields, we did nibble, we reduced to underweight a few days ago as the bond yields got back up to 10%. So we will be tactical in that when there are swings, volatile swings. So right now at about 10%, it's not too bad, but it's more range trading than holding it for a long term. We prefer credit, which gives you a high yield, than bonds with less volatility. Johan says, may one change your investment in the TFSA around it, not happy with this choice without losing tax-free benefit? Johan, I'm pretty sure you can switch within a TFSA. I wouldn't stake my life in it, but from what I remember, I think you can. Ian, can you confirm? Yeah, Ian confirms you can switch within a TFSA. Good question. What is your opinion how the land expiration bill, electricity price hikes, and the water debt issue impact the property market? I did answer that on SA property earlier. These are all headwinds to low growth and high fixed costs when it comes to electricity and water. Those are all going to go up. Electricity didn't go up 36%, but went up 12.7%. That is all something that your landlords have to cover to some extent. Water in particular, maybe less than power, but those are all headwinds to SA property, unfortunately. Thank you, Anonymous. Appreciate that. Hi, Carl. If you, H. Fanikirk says, if you had to choose one RA available fund in your portfolio to invest in this year and have the best growth long-term 20-25 years, what would your choice be? Okay. So what do we know? It's fantastic that you can have a 25-year time horizon. What do you know on 25 years is that the rand is most likely going to be weaker. So you probably want to look at something offshore. Then within offshore, you want the country that has the highest levels of R&D and the highest levels of property protection, your private property rights, so that nothing's going to get nationalized overnight. Now, that clearly is the US. It is the second highest country when it comes to R&D. And the highest country when it comes to protection of your private property rights. China is by far the best country from R&D perspective. It's got the most patents worldwide. It's got the highest levels of R&D worldwide. We are going to see the highest level of innovations coming out of China without doubt. But China is not concerned about monetizing it. They're concerned about making sure that consumers can get the best possible product at the lowest possible price. So, investing in Chinese equities is unlikely to get that return on equity. So, if I had to only invest in one thing in the long term, it would be the S&P 500. Right now, as I said, we're a little bit concerned that there's too much of a premium priced into tech stocks. So we're in the S&P 500 equally weighted, and we're in the S&P 400, which is their mid cap range. So that is how we're playing that in the short term. But certainly, America is, and again, you're going to say, well, it's reflecting the valuations. So that's why you said a 20-year time horizon. If I have to say 10-year time horizon, I would say over the next 10 years, if you look at any Case-Shiller, 10-year PEs, which are very good at predicting long-term movements, your 10-year view is you're going to get a better return out of Europe and Japan than US. But on a 20-year view, that starts to, the exceptionalism of the US feeds back into those long year returns. And on so on a 10-year view, I would focus, well, right now we're focusing on the US because it's the safe haven when things are going wrong, and it's got the most support from fiscal support and monetary support. But on a 10-year view, Europe and Japan, maybe emerging markets, and then on a 20-year view back to the US. So that's, you can pick your time frame and invest accordingly. Mervyn says, you mentioned your underweight SA bonds. Do you foresee an increase in the bond yield over the next few months? Yes, Mervyn, if the rand crashes because of something Trump says, we'll definitely get higher bond yields. If the budget is negative, we'll definitely get higher bond yields. If commodities crash because China doesn't put through a sufficient stimulus, then we'll get higher bond yields. So bond yields will respond higher to any major risk event. And that's unfortunately, while they're not a great diversifier in a portfolio, because they do, when there's something bad happening, the rand weakens and bond yields go up and you lose money on the bonds. Karin says, what is the best investment strategy for grandchildren? Well, hopefully grandchildren is a 20-year time horizon, Karin, and then I'll have the same answer as the previous question. Janine says, is there any talk of increasing the lifetime contribution limit to TFSAs? They have been, surprisingly, they have been increasing that each year. So hopefully they'll do that this year. We'll find out at the budget speech in February. But I'm not sure. Janine Anonymous says, what is your outlook for commodities globally? That's very much dependent on Chinese growth. So we're watching out for Chinese policy support, and that we should hear hopefully some new news in March. Bassi says, I've just joined any discussion around FANG. I don't want to repeat that for everybody else, but this webinar will be on our YouTube channel shortly. And I did go into, probably on the third slide, where it gives the top 5 funds. I gave a long explanation of our view on DeepSeek and how that's impacting US technology, and as a result, the FANG stocks. But in short, we don't have any FANG exposure in our funds. We are overweight the US, so we have overweight FANG indirectly through S&P, but we don't have any FANG stocks directly. Michael says, your blatant TDS is skewing your mind and thoughts. Please stop and be objective. Michael, you'll have to explain what TDS is, and then I'll respond. Devin says, regarding the latest shareholder circular, how does Signia save costs by liquidating odd lot shareholdings? Devin, you'd be amazed at the cost of having to print and post a physical annual report to someone with one share. There is definitely a cost saving. Wesley says again, what is the minimum investment amount for any of your investment portfolios? It does differ depending on what you invest in. If you want to buy one of our ETFs, you can buy it as a small allocation as you want. You can either go through Signia Securities or the Alchemy platform, or Easy Equities to buy a smaller stake as you want in one of our ETFs. So there's no real minimum. Anonymous says, can excess RA contributions below 350 be carried forward? No, there's no carried forward of that. So use it or lose it. Same as TFSA. Marina says a quick question on crypto arbitrage. I think there's some good money to be made on crypto arbitrage if you obviously can short and long. It's complicated, risky, but I'm sure there is, with all the different exchanges out there, some good money to be made. Anonymous says, can you switch within an RA? Yes, you can definitely switch within an RA. Eureka Van Rooyen says, Australian equities, 10-year view, please. Australia is very linked to China. It's their strongest trade partner. So Australia is to some extent linked to Chinese growth. What Australia does have on the good side is strong immigration, and immigration is definitely something that will help. On the negative side, they do have some pension shortfalls, which will hurt. Yeah, I would say we don't hold any direct Australia in the funds, but I think the commodity economy like South Africa, so you've got to have a view on commodities, you've got to have a view on China to have a view on Australia. The one thing I did talk about 6 months ago was property prices, which are a little bit high in both Canada and Australia. Patrick says, does Signet cater for corporate investments? Certainly, Patrick, I think you can invest in a unit trust in any legal entity. So or an ETF, so there's no restriction there. Ockett says, does no exposure to FANG also mean no exposure to FANG AIM ETF? So for clarity, we overweight the S&P 500 in our funds. So we hold NVIDIA and Google and Meta and all those stocks through our S&P 500 overweight. But we don't have any exposure to our FANG ETF or our FANG unit trust or our fourth RR ETF or our fourth RR CIS. Okay, Anonymous says TDS is Trump derangement syndrome. Okay, thank you. So does that mean I think Trump is deranged, or am I deranged because I think Trump is doing things? Certainly there are some people out there who think that he's a madman. I think he has surrounded himself by some very clever people, and as long as he listens to them, I think he's going to do some clever things. So no one person can singularly take on the world, but if you surround yourself with enough clever people and listen to them, I think you can do great things. Thanks, Daniel. David says, just a comment on RA contributions. If it was asked if you can carry excess contributions forward for tax purposes, you actually can. Really? Okay, I wasn't aware of that. Certainly not something I've ever used before. Okay, thank you, David. I appreciate that. I wonder if you can do the same for TFSAs. I wasn't aware. And that's it. Sure, quite a long session, it was 12. Thanks to those who stayed. I'll definitely get a t-shirt printed for the next webinar with I have TDS. And yeah, looking forward to seeing you in March. Have a great month and all the best.